Imagine opening the newspaper every morning and all you see are numbers dancing. Bitcoin up, Bitcoin down, Bitcoin breaking another all-time high. Headlines like that appear every day non-stop without pause. And if you only look at them, you might think the entire story of Bitcoin revolves around price. But that is not the truth. Price is only the surface. Beneath it lies a completely different economic structure, a financial system that requires no intermediaries, a decentralized network operating on a global scale. And according to many recent analyses, we are entering a pivotal phase, the era from 2025 to 2031. Some reports call this the Bitcoin era. So in this video, we are going to do something slightly different. Instead of chasing the daily pumps and dumps, we will look deeper into the three real foundational layers of Bitcoin: the economic structure of the network, the geopolitical role that is beginning to take shape, and the technological resilience of the largest decentralized system in the world, as of March 2026. But to understand why Bitcoin stands where it does today, we have to go back in time to the exact starting point. January 2009, an anonymous figure named Satoshi Nakamoto created the first data block of the Bitcoin network. It is called the Genesis block, the origin block. And what made it special was not only the source code inside. Satoshi embedded within it a headline from The Times. The Times, 3rd of January 2009. Chancellor on brink of second bailout for banks. Roughly translated, the UK Chancellor is preparing to launch a second bailout for banks. This was not a random detail, it was a declaration. Bitcoin was born right after the 2008 financial crisis, a moment when millions of people lost their homes, lost their jobs, lost everything, while large banks were rescued with the taxpayers' own money. The Genesis block was a very direct question being asked. If the current monetary system requires massive bailouts in order to survive, then perhaps we need a different system, one without intermediaries, without central banks, without anyone controlling the flow of money. But to see why that idea was revolutionary, we need to look back at what happened before. Because Bitcoin was not the first attempt. From the 80s and 90s, the cypherpunk community tried many times. One of the most notable projects came from mathematician David Chaum, with DigiCash using blind signatures to allow transaction verification without revealing the identity of users. From a cryptographic perspective, that was a real breakthrough. But DigiCash still failed. For a very simple reason, it still depended on a central server, and when that center collapsed, the entire system collapsed with it. After DigiCash, many other ideas followed. B-Money, by Wei Dai Bit Gold, by Nick Szabo. These projects touched two core concepts, digital scarcity and proof of work. But all of them got stuck on the same problem: double spending. How do you ensure that someone cannot copy money and then spend it twice? With digital files, that is so normal, it is almost obvious. You send a music file to your friend, and the original file still remains on your computer. If money worked that way, it would have almost no economic value. This was the barrier that for decades no one could overcome until Bitcoin appeared. But before talking about how Bitcoin solved that problem, there is a small story in its history that has become legendary. On May 22nd, 2010, programmer Laszlo Hanyecz made the first commercial transaction using Bitcoin, paying 10,000 Bitcoin to buy 2 pizzas. At the time, that amount was only worth a few dozen dollars. But if converted at the Bitcoin price at the end of 2025, 10,000, Bitcoin would be worth more than $1 billion. $1 billion for 2 pizzas. It sounds crazy, but in the history of digital finance, that moment carried enormous meaning because for the first time, a completely digital form of money was used to purchase something real in the physical world. And from that small brick, an entirely new financial system began to be built. But there is one detail in Bitcoin's history that many believe permanently cemented the decentralization of the entire system. It was the disappearance of its founder. In 2011, Satoshi Nakamoto left the internet completely permanently. No press conference, no farewell statement, no transfer of power. He simply left. And behind him, he left nearly 1 million Bitcoin that have never moved a single time since then. Not one transaction, not one sign of access. They have remained untouched on the blockchain from 2011 until today. Pause for a moment and think about that. What happens when a financial system worth trillions of dollars has no CEO, no leader, no board of directors, no parent company? It means there is no one for governments to send a subpoena to, no one for corporations to pressure, no one who can be forced to change the rules of the game. And that very power vacuum has become the strongest foundation of Bitcoin. But the more interesting part lies in the journey that followed. During its first decade, Bitcoin was often seen as something very fringe, an asset for tech enthusiasts, a high-risk speculative instrument, even associated with the image of underground markets on the internet. Then, everything began to change, especially during the period from 2024 to 2025. An asset once viewed as an experiment of the cypherpunk community suddenly appeared on the balance sheets of large corporations, and several countries began seriously discussing the possibility of placing it in their national strategic reserve portfolios. This is not a small shift, it is a complete transformation. And that transition did not happen by accident. It emerged from a macroeconomic context stretched to its limits. Global public debt continues to expand, governments borrow more, central banks print more money, while the entire international financial system still revolves around a single axis, the US dollar. This creates a very sensitive reality. Sometimes the financial system is not only an economic tool, it is also a geopolitical weapon. Financial sanctions, restrictions on international payments, the cutting of access to SWIFT. And from that point, many countries began asking a larger question: does there exist a reserve asset that does not depend on any single nation? We have already seen the first signals from El Salvador recognizing Bitcoin as legal tender to the Bitcoin Act, 2024 being introduced for discussion in the U.S. Senate. Not to judge whether these moves are right or wrong. Politically, the more important point is that discussions like these show Bitcoin has entered the radar of governments. And if we look at this phenomenon through the lens of game theory, we will see a very familiar scenario, the prisoner's dilemma. Imagine an economic superpower or an alliance bloc, like BRICS, quietly beginning to accumulate Bitcoin into its national treasury. Other countries would immediately fall into a dilemma: not participating risks falling behind in the race. To own an asset with absolutely limited supply, but participating would also contribute to pushing the value of the network even higher. The fear of missing out at the nation-state level could create an entirely new equilibrium state in economics that is called a Nash equilibrium, the point at which participation is no longer a gamble, but becomes a rational defensive move. Especially when you place two types of assets side by side. On one side is Bitcoin supply locked at 21 million units, no issuing organization, no counterparty risk, no possibility of bankruptcy. On the other side is fiat currency supply that can expand whenever necessary, and in reality has expanded significantly. According to data from the 2020 to 2025 period, Bitcoin grew more than 1,000%, while the purchasing power of the US dollar declined by about 20%. Add one more factor: Bitcoin can be transferred across borders within minutes, without banks, without physical transportation, and it cannot be stopped at checkpoints. Compared with transporting gold or relying on SWIFT, a censorship-resistant digital asset that is almost impossible to confiscate begins to look attractive in a completely different way. That is the moment when Bitcoin is no longer just technology. It begins to become a real geopolitical variable. And it was precisely that context that created one of the biggest changes in Bitcoin's history: institutional capital flows. For many years, this market was primarily driven by retail investors, people willing to accept high-risk people who believed in the technology very early on. Then an entirely new door opened. In early 2024, the United States officially approved spot Bitcoin ETFs, and the most prominent among them was BlackRock's iShares, Bitcoin Trust IBIT, essentially a red carpet laid out for Wall Street capital to enter the Bitcoin market. Because for large institutions, pension funds, investment funds, banks, ETFs are an extremely familiar structure. No need to self-custody private keys, no need to worry about cold wallets, no need to manage complex technical infrastructure. They simply buy the ETF and already have exposure to Bitcoin. According to data up to 2025, more than 86% of institutional investors either had plans or were already directly allocating capital to Bitcoin. But ETFs are only part of the story. Alongside them, we see a very different strategy from the corporate side, most notably MicroStrategy. Instead of holding cash in its treasury, the company continuously used it to buy more Bitcoin. And over many years, that strategy transformed it into one of the largest institutional holders of Bitcoin in the world. When these two buying forces converge, ETFs from Wall Street and corporate balance sheets, something very interesting begins to happen. Bitcoin's traditional 4-year cycle starts to break down. Historically, the Bitcoin market has revolved around the Bitcoin halving. Roughly every 4 years, the reward given to miners is cut in half, and the market usually enters a strong growth cycle shortly afterward. But this time is different. Even before the 2024 halving occurred, the price of Bitcoin had already broken previous historical records, suggesting that while tightening supply remains important, it is no longer the only driving force. Another sign of maturity is volatility. By 2025, Bitcoin's realized volatility index had dropped to only around 20 to 30%, far lower than in earlier periods. And as the market becomes more stable, macroeconomic factors begin to play a larger role. Bitcoin's price now reacts to global M2, money supply, Federal Reserve interest rate policy, and the liquidity cycle of the world economy. In other words, Bitcoin is gradually being traded like a global macro asset. But this is where the story starts to become truly interesting. Because when you dig deeper into the network structure, there is a hidden issue that is rarely mentioned but is absolutely vital to the entire system, the network's security budget, or more simply, the miner's livelihood. Miners provide the computational power that confirms transactions and protects the network from attacks. Their income comes from two sources: block rewards, the new Bitcoin created after each successfully mined block, and transaction fees paid by users. After the 2024 halving, the reward per block fell to 3.125 Bitcoin. And by the design of the system, that number will continue to be cut in half every 4 years, until it approaches zero around the year 2140. This leads to a very large question. If block rewards continue to shrink, the network will eventually have to rely on transaction fees to survive. But if transaction fees are not large enough, miners will no longer be profitable and will shut down their machines. If enough mining machines leave the network, the total security power protecting the system declines. And at that point, in theory, the risk of a 51% attack increases. This report calls it the transaction fee crisis. In fact, we have already seen a brief period when this problem seemed to be solved. In 2024, new protocols, such as Bitcoin Ordinals and the Runes protocol, caused activity on the network to explode, transaction fees surged, and miners earned a great deal of money. But that bubble did not last. By August 2025, the share of these types of transactions dropped from around 60% to only about 20% of total network activity. As a result, by the end of 2025, transaction fees contributed only about 0.78% to 1.35% of total miner income, not even 1%. And that raises an unavoidable question: if block rewards continue to decline, but transaction fees remain that low, who will pay to secure the Bitcoin network? But pause for a moment at that number under 1%. When transaction fees account for less than 1% of miners' income, that is no longer a minor detail. It is a real alarm bell for the security structure of Bitcoin. A study from the University of Cambridge, cited in the report, reaches a rather cold conclusion. If transaction fees continue to remain that low, the safety of the network will depend almost entirely on a single factor. The price of Bitcoin must continue to rise strongly and sustainably. According to estimates in that study, in order for miners' revenue not to fall into negative territory, the price of Bitcoin would need to increase by roughly 30% per year. During the period from 2024 to 2028, an extremely ambitious assumption. And when we look at the hash price index measuring the revenue that a unit of computational power can generate, the picture becomes even clearer. In the previous cycle, hash price usually fluctuated between 80 and 120 US dollars. By 2025, that number had dropped to only around 35 to 65 US dollars. Put bluntly, miners are earning far less for the same amount of work. And that is creating a very familiar consequence in economics, a brutal process of selection. What is interesting is that despite declining profits, the total computational power of the network continues to increase. By October 2025, the global hash rate reached a record of around 1.15 zettahashes per second, a figure never seen before in Bitcoin's history. But that very fact is making competition more intense than ever. Break-even costs keep rising, and in that environment, the first to be pushed out of the game are always small-scale miners, individuals running a few machines at home, mid-sized companies without advantages in cheap electricity or optimized infrastructure. They simply cannot compete with large corporations. The result is that the mining industry is becoming increasingly concentrated, with most of the global hash rate in the hands of large-scale companies, many of which are already publicly listed on stock exchanges. According to this report, the large company group alone controls nearly 40% of the global computational power. Another structural shift is also taking place in parallel. In the past, the Bitcoin mining industry had two very clear groups: hardware manufacturing companies and mining operators. But that boundary is beginning to blur. Large manufacturers, such as Bitmain and Canaan, started asking a very logical question: if we are the ones creating mining machines, why only sell them to others? Bitdeer is a typical example. Within just 1 year, its self-mining capacity increased fivefold, reaching about 41.2 exahashes per second by October 2025. All of this leads to a rather sensitive consequence. Bitcoin was designed with a core ideal of decentralization. No one controls the network. But as the hash rate becomes increasingly concentrated in the hands of a small number of large corporations, a question begins to emerge: is the level of decentralization at the base layer being eroded? If most of the hash rate lies in the hands of public companies, then in theory, governments could apply legal pressure requiring them to block certain transactions or comply with sanction lists. That is not something that has happened, but the mere possibility of it is enough to concern many analysts, because when it comes to Bitcoin, decentralization is not a secondary detail, it is the heart of the entire system. But while the base layer is struggling with the cost problem, another part of the ecosystem is developing in the completely opposite direction. That is the second layer solutions built on top of Bitcoin to process transactions faster and cheaper, and the most prominent name is the Lightning Network. According to the report in November 2025, the Lightning Network processed about 1.1 billion US dollars in transaction value, equivalent to 5.2 million transactions in just a single month. And the most interesting point lies in another detail. The average value per transaction increased from around 118 US dollars the previous year to 223 US dollars, showing that the Lightning Network is no longer used only to buy a cup of coffee, but is beginning to serve larger value transactions in the real economy. And the development of the Lightning Network does not stop at small retail transactions. In its early years, Lightning was often mentioned with a very familiar example: buying a cup of coffee, paying for a small meal. But by the period of 2025 to 2026, the story had changed. Lightning began to be used for B2B payments, where businesses can pay each other almost instantly with costs that are virtually zero. But what is truly interesting lies in another trend, a trend that sounds as if it came straight out of a science fiction film. Imagine an ecosystem where artificial intelligence systems transact directly with one another. An AI needs to rent additional computing power. A trading bot needs to purchase real-time data. An automated system needs to access the API of another AI. In all of those situations, instead of humans making the payment, the machines pay each other instantly automatically without human intervention. And this is exactly where the Lightning Networks becomes extremely suitable, with transactions processed within milliseconds and fees that are nearly zero. According to some researchers, this could become the financial circulatory system of the machine economy, a place where software can buy data, rent resources, and pay for services in real time, without banks, without invoices, without a human pressing the approve button. However, the path of expansion for the Lightning Network is far from smooth because there is a fairly clear reality: Lightning is not easy to use for ordinary users. To operate a Lightning node yourself and open payment channels, you need to understand liquidity management, transaction routing, and how to open and close payment channels, a significant barrier for many people. And whenever such a gap appears, the market almost always responds in the same way. Large exchanges, such as Coinbase and Kraken, have begun building liquidity hubs, large-scale liquidity centers, so that users only need to connect directly, instead of opening complex Lightning channels themselves. Transactions become faster, fees become lower, and success rates become higher. But that convenience comes with a downside. When most Lightning transactions pass through a few large liquidity hubs, we unintentionally create choke points, new concentrations where a significant portion of Layer 2 money flow is routed through a small number of entities. That does not break the system, but it raises a very familiar question in the Bitcoin world: is convenience beginning to trade away part of decentralization? On one side is optimizing user experience, on the other is preserving the original philosophy. This is a tension that will not be easy to resolve. But if we look at the entire system from a greater distance, Bitcoin still demonstrates remarkable resilience when facing unexpected shocks. January 2026 provided a very interesting example. A historic snowstorm swept across a large part of the United States, with conditions so extreme that around 40% of the global Bitcoin mining power had to temporarily shut down. Yet the network did not collapse. Miners voluntarily powered down their machines to free electricity for the regional grid, a form of extremely flexible demand response mechanism. When the storm ended, the mining machines turned back on the network, automatically adjusted mining difficulty, the hash rate recovered, and blocks continued to be produced without any central engineer coordinating the process, without any reset button. The system recovered by itself, almost as if nothing had happened. But no matter how well the system can adapt, another threat is slowly appearing on the horizon: not a natural disaster, not the market, but an entirely new technological leap that you cannot solve simply by turning mining machines back on. That threat is quantum computing. For many years, this concept was often treated as science fiction. But now, it is beginning to become a very serious, long-term technical risk. The security heart of Bitcoin today relies on the ECDSA algorithm, ensuring that only the holder of the private key can spend their coins. But in theory, a sufficiently powerful quantum computer could break this type of cryptography. For many years, scientists believed that would require millions of qubits, a scale that was still very far away. But in 2025, several new studies began raising a question: could that barrier actually be lower than we once thought? A study published in 2025 showed that to break the RSA 2048 encryption algorithm, the security foundation of many internet systems today, a quantum computer, may require only about 1,399 logical qubits, far smaller than what scientists had previously predicted. And if that is true, The timeline for a global cryptographic crisis no longer lies in the distant future. It could emerge as early as the beginning of the 2030s. Therefore, the Bitcoin development community has already begun preparing. In February 2026, a new technical proposal was introduced, Bitcoin Improvement Proposal 360 BIP 360. The core idea is to use a pay-to-MPC structure. The user's public key would be hidden behind a more complex hashing layer, creating a form of quantum-resistant shield. From a technical perspective, this solution is quite reasonable. But when reading the document carefully, there is one detail that worries many people: the transition timeline. According to estimates, the migration process from the current cryptographic system to a completely new quantum-resistant standard could take up to 7 years. And during that entire period, the whole ecosystem would have to upgrade simultaneously from mobile wallets on users' phones to exchange custody systems, node software, and the security infrastructure of the entire network. Every link in the chain would have to change. But the larger issue lies in a much harder question. What about the Bitcoin that has been abandoned? According to analysis in the report, around 10% to 15% of the total Bitcoin supply currently sits in Old P. 2PK wallet addresses the type of address where the public key has already been fully exposed on the blockchain. If a sufficiently powerful quantum computer appears, those addresses would be among the easiest targets to attack. And among them is one particularly notable name, roughly 1 million Bitcoin belonging to Satoshi Nakamoto himself. To upgrade to the new security standard, the owner must create a transaction to move the coins into the new address structure. But if the owner disappeared 15 years ago, you cannot force someone who no longer exists to return to the internet to sign a transaction. If those coins remain permanently unmoved, they could become the largest exposed gold mine in the history of Bitcoin, simply waiting for a sufficiently powerful quantum computer to appear. It is a very peculiar paradox. A system designed not to depend on humans could be threatened precisely because humans disappear. But if we step back and look at this entire journey, the story of Bitcoin is truly quite remarkable. It began with the ideas of the cypherpunk movement, a small group that believed the internet could create a new monetary system. From experiments like DigiCash to the moment Satoshi Nakamoto published the Bitcoin white paper in 2008. And less than 2 decades later, we are talking about a financial network being placed on the balance sheets of large corporations, discussed by nations as a strategic reserve asset, and used to build payment infrastructure for the internet economy. The most important thing may not lie in the price of Bitcoin, not in the charts, not in the market cycles. What matters is the trajectory of this system. Because when you truly understand Bitcoin, you are seeing many things at once. The future of digital sovereignty, the way mining operations could become buffers for energy grids, and the possibility of a payment system for the AI economy. A picture where technology, economics, and geopolitics intertwine in ways never seen before. And, before ending, there is a scenario in this report that is truly thought-provoking. Imagine this. In the future, AI systems use the Lightning Network to execute millions of transactions every day, completely automatically with no humans in between. At the same time, threats such as quantum computing force the network to deploy self-upgrading security mechanisms, all triggered automatically, without programmers, without administrators. If those two trends continue to develop, we may enter a very strange scenario, a massive financial economy, operated, protected, and used by non-human entities. A system that humans created but no longer truly control. And at that point, we may become passengers, sitting and observing a giant financial train running autonomously on the rails of the internet. A vision that is both astonishing and deeply thought-provoking. And perhaps that is exactly why the story of Bitcoin is worth following, not only because of its price, but because of where it might lead the entire global financial system in the future.